You're watching France 24. It's time for business. We say hello to Kate Moody.
Hi, Francois.
They haven't closed the faucet on quantitative easing, but the European Central Bank signaling that it soon may be over.
Yeah, more of a drip coming out of the ECB, if we're going to continue that analogy. As broadly expected, Mario Draghi has outlined a plan to extend but begin scaling back support of the EU economy. The European Central Bank has been pumping money into the economy since March 2015, first at a rate of 60 billion euros a month, then 80 billion, and then earlier this year it was scaled back to 60. And that will continue through the end of 2017 and then be cut in half, so purchasing 30 billion euros worth of assets each month through next September. That's the plan for now. ECB's Mario Draghi saying the changes did not amount to a tapering, but rather a downsizing of a program which remains open-ended as inflation creeps closer to the 2% target.
The recalibration of our asset purchases reflects growing confidence in the gradual convergence of inflation rates towards our inflation aim.
Now for more, we can cross to Neil Wilson, Senior Markets Analyst at ETX in London. Neil, thanks for speaking to us. Is there anything surprising about this extension and scaling back of the quantitative easing program? Do you think Mario Draghi was right to remain so cautious?
Well, I think there was not any great surprise in the announcement today. We were expecting something in the region of 30 billion for around 9 months, maybe a little bit longer. Mario Draghi indicated that it's going to stay in the market for a very long time, that there's not going to be a sudden stop to QE. So that entails further extension beyond September 2018. I think that's by and large what the market was expecting. And I think we've seen a bit of a reaction to that in the markets today, with the euro obviously falling a little bit, with what seems like it's on the dovish side, although still within the bounds of what we were expecting.
When you look at the state of Europe's economy now, how successful do you think this program of bond buying has really been?
Well, on the face of it, you have to say that the ECB's carried out a very positive policy in that for the economy. The European economy is doing very well, and inflation, although it's not at target, and inflation is ticking along quite nicely. So for consumers, that's a good thing. And we've seen that the economy has also managed to weather the strength in the euro. We're not seeing any real hit to corporate earnings and that sort of thing yet. So I think you could definitely describe the QE program as a big success. That the problem is exiting it without roiling the markets. But what we've seen today is that the ECB has done a very good job in shepherding the market's expectations towards expecting the taper, hence why the reaction in the markets has been fairly positive, what you might say muted.
Now, the other thing we look to central banks for is the question of interest rates. Mario Draghi indicating they're likely to stay put until at least 2019 at this point.
Yes, I think with the forward guidance being as it is, where the ECB is saying that it won't hike interest rates until well past the horizon of QE. That entails, at the current rate of knots, that would mean interest rates certainly not rising to 2019, possibly even 2020. So they are kicking the can down the road, but there's really no rush for them to exit, to tighten particularly quickly at the moment. So I think Draghi's taking a fairly cautious line, and he's got the elbow room to do that at the moment.
Yeah, gradual, apparently the word of the day for Mario Draghi. Do you think that this gradual pace of scaling back support is going to really help inflation get to that 2%?
Well, I think what we've seen is how the effect that central banks and monetary policy has on inflation is diminished. We've seen that people talk about the Phillips curve being broken, and I think really there are bigger factors at work in terms of technology and globalization and all sorts of things going on. It is harder for central banks to deliver inflation just with these monetary policy tools that they have, but they have to keep trying. And I think possibly if the euro starts to weaken against a dollar, which may off the back of perhaps a new Fed appointment, Fed chair appointment, and we're seeing Treasury yields rising. If the dollar does start to strengthen again and the euro weakens, then that could help inflation tick up over the coming months.
Neil, you mentioned the Fed there. If we could briefly just turn our attention to America's central bank, the question of who might lead it next. Janet Yellen, of course, seen as a safe pair of hands, but there's growing speculation that Donald Trump might nominate an outsider. How would markets respond to that?
That's right. I think there's been reports today saying Yellen's already out of the race. So we're not entirely sure how much we can put on these. But I think clearly Yellen's a dove. I think the people that might replace her would, at the moment, the top candidates look slightly more hawkish or even a lot more hawkish. So I think if Yellen goes, and one of these sort of more hawkish types enters, then I think we would see Treasury yields rise again. I think we are seeing that the market is beginning to take the Fed's commitment to hiking rates again beyond the December rate hike, which is already expected. I think the market is beginning to take that a bit more seriously, and if we see Yellen go, then they'll probably take it even more seriously after that.
All right, Neil Wilson from ETX, thanks so much for joining us this evening.
Thank you.
We'll finish up with a look at how the stock markets have been responding. European stocks shot upwards after Draghi's announcement, the gradual shift coming as a relief to investors. The DAX and CAC 40 gaining nearly 1.5% each there, and Madrid's IBEX 35 up nearly 2%. Wall Street's being driven more by earnings, but U.S. stocks are recovering from Wednesday's losses. Twitter shares are up 17% after posting better than expected revenue. And I'll have more on that in the next Business Bulletin, Francois.
All right, many thanks for that, Kate Moody.